Robert, those bonds pay you a set amount of interest. One of the great things about real estate, and one of the great things about being an entrepreneur, going back to Rich Dad, Poor Dad, is you put yourself in the position of being a price maker, where other people are price takers. The majority of people are price takers, so they have to take whatever price is offered by whatever it is they want to buy. But the real estate owner, the apartment owner, let's say, or the business owner, can raise their prices if the rate of inflation is going up. So it hedges you against inflation while at the same time paying you to own it with that positive cash flow. And a bondholder does not have that opportunity, to say the least.
I was at the gym just now, and before everybody came out, I said, I felt for this guy. He says, I've been a bus driver for 40 years. I'm going to retire, and I can't wait. He's turned 65. I said, what do you got? He said, I got a 401k. I said, what's it filled with? He says, oh, I just sold all my stocks at the top of the market, and I went into bonds.
Right.
George, what did he just do?
The most stupid thing he could possibly have done, to put it mildly.
Why is that?
Well,
George, you shouldn't laugh at the poor guy.
Yeah, no,
I almost cried.
Yeah, I'm giving a hard time, of course, but I wanted to say it like that to really emphasize the point that, first of all, you should never put all your eggs in one basket, but especially not the bond market right now with all the money printing that you referred to earlier. Robert, before you said you think the market is going to crash, so whether that's the stock market, real estate market, the question is, does it crash in nominal terms or adjusted for inflation? See, the stock market can stay the same as it is right now, but if we get 10% inflation because of all the money printing, you'll actually lose purchasing power. You see, so the market can crash up just as easy as it can crash down if your definition of a crash is losing purchasing power. So if you're someone that believes, like I do, that once the Fed starts printing all this money, the government prints all this money with stimulus and whatnot, they cannot stop. It's like a heroin addict. The only thing they can do is print more and more and more. And if they can't reverse course, then you need to start thinking through your portfolio in terms of hard assets, because you're getting a future stream of dollars. That's all a bond is. You're buying a bond for $1,000, and they're saying, okay, in 10 years, we're going to give you $1,000 back. And along the way, we'll pay you a little bit of interest. I mean, it's negligible at best. So what happens if we have a high rate of inflation because of the money printing? You're going to get paid that $1,000 back, but it's going to buy you a loaf of bread. So you don't get back your purchasing power. You only get back your dollars.
Yeah. If I could add one more thing about the relationship. See, when I look at this stuff, I'm looking at the relationship between equities or stocks and bonds. And so the reason the stock market went up is they kept dropping the interest rates on the bonds. So, when I started off, interest rates were about 16%.
Yeah. Right.
So if I had a bond, I was getting 16% interest. That was a very valuable bond. If they dropped the interest rate to 14%, my 16% bond was more valuable. Does that make sense? It's like my cash flow from the bond or the dividend was good. And so when the market kept crashing, they dropped it to 8. And today, I think it's about 2.5 on the long bond. So as to keep the stock market up, they had to keep dropping the bond prices down. And now we're at zero. They call it the zero bound.
Yeah.
And that's where Japan is.
Yeah, for a long time.
If they can't keep dropping that bond price, the stock market comes down. So that's the correlation between equities, stocks, and bonds. So this is my question, George. So let's say today, bonds are 2%, long bond, 10 year. What happens if it goes to 5%? Because inflation comes in, they have to raise the bond rate to 5%. What happens to the 2-year bond?
The value of the bonds purchased at 2% goes down.
Yeah, and that's what that guy did.
That's right. He's buying a bunch of stuff with a value. You really can't get any capital gain on it. But most likely you're going to be stuck holding that thing until it matures, and that's not going to be good in inflation. Another thing, Robert, those bonds pay you a set amount of interest. One of the great things about real estate, and one of the great things about being an entrepreneur, going back to Rich Dad, Poor Dad, is you put yourself in the position of being a price maker, where other people are price takers. The majority of people are price takers, so they have to take whatever price is offered by whatever it is they want to buy. But the real estate owner, the apartment owner, let's say, or the business owner, can raise their prices if the rate of inflation is going up. So it hedges you against inflation while at the same time paying you to own it with that positive cash flow. And a bondholder does not have that opportunity, to say the least.
Which goes back to why all of us are entrepreneurs and why all of us invest in real estate, is because we want to be able to control our assets. And
That's
you're
right.
saying we can't control the bond market, we can't control the real estate market, we can control our properties and we can control our businesses.
Robert, those bonds pay you a set amount of interest. One of the great things about real estate, and one of the great things about being an entrepreneur, going back to Rich Dad, Poor Dad, is you put yourself in the position of being a price maker, where other people are price takers. The majority of people are price takers, so they have to take whatever price is offered by whatever it is they want to buy. But the real estate owner, the apartment owner, let's say, or the business owner, can raise their prices if the rate of inflation is going up. So it hedges you against inflation while at the same time paying you to own it with that positive cash flow. And a bondholder does not have that opportunity, to say the least.
That's why if they raise the interest rate on the bonds, the stock market comes down. Because the reason the stock market went up is because bond prices were coming down. So this guy sees the stock market going up. So he says, okay, I got out. I went into bonds. I went, oh my God.
Yeah, so the opposite way to play that, and I think the smart way, is if you own a cash flow property, but you own it with 30-year fixed rate debt, you're going to be paying your debt back in devalued dollars. So you're going to increase your purchasing power. You're actually going to make money. You're going to increase your purchasing power on the debt itself, even if the asset, the property, goes down a little bit or up a little bit. It really doesn't matter. And but to be clear, in order to do that, you need a certain degree of sophistication. You don't have to be a rocket scientist by any stretch of the imagination, but you can't be green and just go in there and just pick any house off the MLS, as an example, and just because you've got a loan on it, think that you're going to benefit from inflation. You're probably going to get run over. But if you're like Kenny, as an example, and you know how to really leverage that, then you're going to use it as an opportunity. And now is a great time to get in if you have that level of expertise.